All right, so it's 7:05, so we'll start now. Hi, everyone. Thanks for joining today. I'm Ritesh. I head the investment advisory team at Syfe, and I will be the moderator for the session today. Today's webinar will be focused on Equity100, our latest launched portfolio. And as you can gather from the name of the portfolio, it is designed for investors who want to maximize their exposure to global equities. Today's session will be hosted by Dhruv Arora. He's the CEO and founder of Syfe. And alongside Dhruv, we will also have Richard Ye. So Richard is the head of portfolio construction and risk management at Syfe. So both of them will sort of, lead the show. Feel free to post any questions that you might have through the session. So there is a Q&A section down at the bottom. So feel free to ask any questions throughout the webinar. And I will try my best to post as many of them as possible to the hosts. So without further ado, over to you, Dhruv.
Thank you so much, guys. And thanks so much for joining us today for our webinar on our new launch. Now, I think, as you might have seen, right, at Syfe, we've always, right from even before we started, we've always built products in mind of what consumers want. And though, we've had spectacular success both with our global risk managed offering as well as what some people know recently better for, which is a REIT offering, there was a requirement which came from a fairly decent, a set of audiences which wanted an easy way to purely access, equities. And the view was that, we have some of our savings, we have CPF, we have some fixed deposits, some of you have, the saving bonds as well. Can I actually add a pure equity component? I don't want really, a bond or a gold in it. The way how we see it is that this product is, a great addition to the suite of what, Syfe wants to offer and what Syfe wants to build. And I'll go through some of the characteristics on this, as we get along. With me, of course, we have Richard, who's the brains behind this product. So, you can be as technical as you like. And of course, we'll go a little bit technical, into the framework of building out this product. But, of course, we will have a deeper session later on if that's something that interests you as well. All right, so let's get straight to it, right? So currently, as I just quickly mentioned, right, some of you know us for our global offering, which is what we started with. This is risk managed, focuses on maintaining a downside risk of the portfolio. So it's somewhere it's trying to ensure that, your losses are contained or its losses are managed, right? The REIT Plus, on the other hand, is a bit more on the passive income side. All of us, we love real estate, but one of the key aspects of REIT Plus also was to, launch something that gives some sort of passive income. And even though, there potentially be some sort of dividend cuts, the yield will be very, very attractive given the fact almost every bank is cutting down rates, as many of you have seen. Which brings me to, the middle red box, which is Equity100. So what Equity100 is, right? From our perspective, it's a natural extension to our current portfolio offerings, right? It is 100% allocated to equities. It will always and always be 100% allocated to equities, leaving a very small sub 1% for cash and fees management. 99% plus of it will always and always be in equities, right? We try to build these portfolios using a smart beta strategy, as well as deploy factor tilts. Now, this might sound a little too much, so I'll come on to a specific slide where we'll talk about it. But the goal is that, we're trying to give exposure to a global diverse set of ETFs. As you will see, there is a bit of a heavier bias towards technology. But of course, this is not just a pure market cap kind of a setup, because then you can just go and buy a market cap ETF. There's a value in constructing portfolio this way, and that is something, which we'll share as we go. As you might already know, we are CMS licensed by the MAS, which is what helps us to actually, create portfolios. And unlike, some of the other providers who are just, I guess, financial advisor licensed, typically they end up just, selling products from other guys because they generally can't create. But like we've done with our REIT offering, the same thing out here is something where we've created uniquely on back of user feedback. So briefly, the portfolio currency is USD. As you know that you can still wire it in SGD, and we have extremely attractive, almost 90% cheaper than normal forex conversion rates, which have been negotiated by our broker. So we will pass the same, that same fees, to you. So you can pass Singapore dollars or you can put USD. There is no minimum investment if you are investing in Singapore dollars. If you're putting it in USD, it has $10,000. Some people ask us, why is that the case? The fact is that DBS just charges us for USD banks transfer. So it's not to make money, actually we used to lose money on those. But of course, if you have USD and you want to deploy that, then you can place that in. The number of stocks that this actually covers across, of course, we buy ETFs, which actually have their own underlyings. It's north of actually 1,500, stocks. And the annual average returns for the last 10 years have been about 13.4%. So this actually includes, the recent moves that have happened in the market, also the whole correction, and then the wave up as well. And that's again the advantage of diversifying and building, something that we do here. In a nutshell, as I mentioned, again, it's equity. It's always 100%. It uses, smart beta strategy. And, we've seen that this gives higher risk adjusted returns as compared to just a pure, market cap strategy, right? Then you can essentially just combine S&P 500 ETF, right? And, as I mentioned, it's got, again, over 1,500 stocks. As you can see on the right-hand side, this has some of the most popular names you want, whether it's Amazon, Netflix, Microsoft, P&G, Visa, or even, some of, like something like, a Toyota or a Coca-Cola. So you will see when we talk about the constituents that it's actually very, very good. So something like, the best 1,500 companies of the world somewhere, rolled up into one kind of a setup and making it accessible, for you. So which actually comes down to the focus of, how we have built it and what is actually smart beta, right? Everyone, uses this word. What exactly is smart beta? This is where I'll let the expert come in. And Richard, I think this is where you unmute, and over to you for explaining actually what is smart beta and how actually are we using it to generate better returns than just a pure market cap setup.
Okay, actually this smart beta thing, before I get into smart beta, it's not something that's totally new. We have actually been using it in our global portfolios, but this has kind of been sort of under the hood kind of a thing. This Equity100 was, as Drew said, in response, to clients, that wanted to do their own strategy, wanted to manage, like, let's say, for example, dollar cost averaging and so forth. So what we do is we respond to the clients, and effectively what we did was we carved out the equity component of our global portfolios. And then we basically said, look, if you guys want to invest 100% into equity, we will carve this out. We won't do any risk management per se, right? It will always be 100% equity. But what we would do is give you the best risk-adjusted return. Okay, so the focus here is slightly different. It is not, the protection of the downside, but it's really giving you the best bang for your buck. And how we do this is we start off with the premise, of a market cap portfolio, which is global. Okay, then we say what we do is how can we add value to it. Okay, so this moniker smart beta means a lot of different things to different people, but essentially currently if you ask the market, there is no definitive definition for smart beta except that the weights are different than the market cap weights. So broadly, as long as the market cap weights are different, as long as the weights of your portfolio are different than market cap weights, people can call it smart beta very loosely. Okay, but in a sense, the more academic type or more narrow focus, the focus of fraternity basically looks at smart beta as factor investing. Okay, so what is factor investing? The very basics of factor investing was actually designed, by these two professors, Nobel laureate Eugene Farmer and Ken French, when they were both professors at the University of Chicago. And basically, what they did was this: they said, look, CAPM, which won Harry Markowitz the Nobel Prize, just basically looks at the market, but it says, well, the market, according to our research, is not enough. So what else is there? Okay, so the original model, which is the premise for a lot of smart beta strategies now in terms of factors, is that you have three factors. Okay, so factor number one obviously is the market, which is the basis of CAPM. Factor number two, what they discovered was if you have small stocks over the longer term, because systematically they're riskier, you will get this risk premium, which is that the systematic returns that you get for investing in small stocks. This is your reward, right? And the other one is value. Okay, so value means what? Value means that you can actually buy a stock cheap. Okay, so the way they determine value is this thing called book to price. Okay, so they have these three factors, and they essentially manage these three things. So that says, okay, if you basically take, let's say, a benchmark, and you tilt towards small stocks and you tilt towards value stocks, that over time that you will systematically be compensated the same way that over time when you invest in markets you'll be compensated. Okay, so in a sense, where does smart beta sit in the realm of things? On the one hand, you have so-called passive strategies where in a sense you invest in, let's say, for example, the S&P 500. So you just do market cap weighted S&P 500. It's obviously been a very hard benchmark to beat because studies have shown that over a long term, let's say like 10 years, 85 to 90% of the active managers underperform this benchmark. Okay, now active means that you basically pick stocks and you put them together in a portfolio. You do all your screens and so forth, and in a sense, what you do is you build a portfolio that you think is the best. Okay, so smart beta sort of sits somewhere in between, active and passive. Okay, so active sometimes you're trying to generate alpha. Okay, passive you try and generate beta. Okay, so smart beta is somewhere in between. So it's very rules based. It's very focused on investing in factors. Okay, so as I said, the very origins of factors were the farmer French factors, but since then obviously there have been quite a few more. Okay, and even farmer and French subsequently has actually expanded their 3 factors to 5 factors, but what we're trying to do is sort of give you an idea that the basis of what smart beta is kind of inculcated in the farmer French 3-factor model, which was designed in 1993, right? So I think for us, what we found is that yes, over the long term, if you basically don't mind it, you can do value, you can do size, and a lot of factor investors basically do that. Okay, but the problem is that we found that if you don't look at it dynamically, because these factors are cyclical, so over time they will come back. But in the meantime, you could have 2, 3, 5 years where your value factors are not performing, which is what has happened over the last 3 to 5 years. Okay, so if you are a value investor, by investing in value, the last 5 years you would have underperformed a passive benchmark. Okay, so what we do is we model the dynamics of these factors, and we at this moment have basically come up with 3 factors that we tilt towards. One is growth, and the other one is large caps as opposed to small caps, and the third thing is low volatility. Okay, which is not something that the farmer French factor, farmer French model indicated, but it is subsequent research to that, and low volatility is one of the factors that we basically tilt towards. Okay, Dhruv, back to you.
Yeah, thanks for that, Richard. Yeah, I mean, of course, it is a little bit technical, and I think you've given a relatively, I guess as layman explanation of that can be. So, of course, if somebody would like to get more technical about it, of course, we'll stay on at the end, and we have the exact deep dive and the models that actually get into this. But to give a, just to like summarize, the factors that, Richard mentioned, whereas which are on your screen right now, come across as, as growth, as volatility, try to keep the volatility low, and traditionally, because there's always the correlation between volatility and returns, and then of course over time we expect the large caps to actually continue outperforming the small caps as a unit, right? Which is why you see some of the bigger companies as the focus, or the larger weights, even in our construction of the Equity 100. So the next question is, how is the asset allocation? So as you can see currently, right, and we're not hooked onto this or these 10, but currently we use 10 ETFs to build our Equity 100 portfolio. On the left of the screen, you are seeing there about 5 of these ETFs, which actually end up bringing in the global market equity. So as you can see, there is, emerging equities. As you can see, there is, the developed world. And then of course there is, the S&P. We use the UCITS fund out here, which actually is quite interesting. But as there's about 30% weightage, which is actually getting into, the global market equities. On the right-hand side of the left, under the asset allocation piece, you can actually see where, the smart beta is actually coming from. And if you see, this is coming from a few sector ETFs, largely, on the consumer staple side. But a very big weight actually is the Invesco QQQ, which, as you know, essentially tries to replicate the NASDAQ, right? Which is, if you go on the right-hand side of your screen, you see there's a very, relatively high weightage of about 27% on technology. And given, where things are and things have been going, I think this trend will only accelerate and will continue. So I think it's quite unique that we're not like, offering a technology play, but more, when we try to address the smart beta aspect, technology becomes an important aspect to it. And this product becomes a great way to have a decent exposure to technology, yet diversified enough to give you, the aspects that get along with building a holistic, diversified portfolio. And on this screen, you can actually see how some of the performance works. As some of this is actually back tested, but this is all, factual numbers, because this portfolio, unlike, our risk managed portfolio, is relatively, static in nature, right? And if you see, right, over time, essentially, at the bottom of the screen, you can see the Equity 100 return actually outperforms both MSCI World as well as S&P, 500, and has a higher, Sharpe ratio and a lower standard, deviation. And this trend actually is both something that has happened over the last 1 year, but also over, the last 15 years or whatever longer duration you want. The point is, we've actually even included the so-called bad years or the bad months, let's say, of March and April, when you look at the 1 year performance, or the bad years such as 2008 into a long-term performance. So if someone's looking for an easy way to invest and let us manage it for you, but not just go and get an S&P piece, for example, and plus, or put in small sizes and keep on topping up, or put a large size and get it managed by us, I think this becomes an incredibly powerful tool. As I mentioned a couple of times earlier, we think this is a great way. If you think of your entire financial portfolio, you might have a house, you might have some savings, you might have some, I guess, personal equities you like. We think this becomes a very, very interesting, product to complete that suite. And especially if you have a view which is, extremely like pro equities, or you want to just, you're relatively young and you have a 20-year, time span, and I just in 20 years equities are going to rise because for a long time they always end up giving positive returns. Then this is a great product for you to invest and let us manage, right? We'll reinvest the dividends for you. We'll manage any kind of, corporate actions. And of course, we will obviously continuously, try to build on the lines of smart beta and generate that little bit of an outperformance versus just buying a straightforward S&P 500 ETF. One very common question that gets asked to us is, how does withholding tax actually get handled, right? And we've seen that some of the, providers are actually misleading customers about the evil of withholding tax or how bad it is and so on and so forth. So let's actually, I thought it's important that we, explain to our users where, the whole aspect and how taxes are really work. Firstly, the taxes are only and only on your dividends. They are actually not on your entire, capital gain, right? So firstly, it's a very small fraction of your, if I look at this previous slide where you're seeing roughly about a 10%, annual return, in that case, what is coming out of dividend from that is a very, very small fee. So on average, it's just about 1.5%. Now, if coming back to this screen, you see, we actually take this into consideration when we build our portfolios. So there is some advantage of going for UCITS funds in some cases, but it's not always true. There's a big misconception that I can save 15% of my dividends, so it's actually a great trade. And we've used two examples where it makes sense. The first case is for the S&P 500. We, instead of using SPY, we have used a CSPX, because here it has a lower withholding tax 15% versus 30%. So it increases a little bit of, advantage that you can get. But bear in mind, when it comes to majority of ETFs, the liquidity and the spreads sometimes can be much, much more expensive than the actual saving you have on taxes. Now, this one, the CSPX on the left of the screen actually is very, very good. So we can still work and trade. On the right-hand side, you have, for example, QQQ, which, as you've seen in the previous slides, is actually a significant part, almost 40% of our portfolio. Now, I've actually shown you how their own UCITS and how they're existing withholding tax. Firstly, the tax that the dividend that they give out is actually just close to about 65 basis points. So it's not that high. So after the withholding tax, this post-tax dividend, as you can see, on the right of the screen, is actually 46 basis points. EQQ has 15%, but even the dividend is slightly lower. So effectively, you get 49 basis points. So you can rightly say that, oh, I'm saving 3 basis points, which is actually negligible if I go for EQQQ. However, what some people don't realize is the management fees of this. The management fees of EQQ is about 10 basis points higher. So net, actually, if you trade the US line, you are actually plus 7 basis points better. But at the same time, that is also excluding the whole liquidity and the spreads and the other factors where, US lines are very effective. So don't let people mislead you into say that if it's UCIT, it's great. I mean, UCITs probably make a lot of sense for, investors who are buying hundreds of millions of dollars of shares, and they can go and create and so on and so forth. But for a retail investor, and I've been trading ETFs for the last almost about 15 years now. Used to run the desk at the distribution desk at UBS. UCITS are great if you're trading in massive size, but for retail investors, by and large, leaving a handful, they can actually have quite a negative impact also. So bear in mind that there are different factors to consider, but most importantly, this entire withholding tax is only on your dividends, and hence actually it's a very, very small proportion. If you look at your portfolio performance, this entire thing will be just 1 or 2% of that entire portfolio performance. So it's not actually that significant. But I think it was important to address this heads up. Because we do give consideration to this when we build our portfolios, and we're sensible. Like in the case of S&P 500, we have chosen a UCIT compliant fund, right? With that, actually, we wanted to keep this as a brief and an interactive session. So with that, actually, I will just temporarily actually stop my screen share, and would love to take on some questions from people, right? So. Ritesh, why go on and why don't you shoot some questions for us?
Sure. Actually, a lot of questions have come in while you guys were talking about the portfolio. So I think a lot of interest in terms of understanding the smart beta strategy a little bit better, as well as people have questions around how do they visualize this portfolio versus like the existing global portfolios per se, right? So I think one of the questions, for example, is, how do we use the Equity100 portfolio vis-a-vis, the global portfolios? And what is the difference between our RE methodology and the smart beta approach of the Equity100 portfolio?
Yeah, sure. You said there was one question to also understand a bit more on smart beta.
So a little bit more layman understanding. So I think you guys already covered it to a fair degree.
Yeah. Richard, you want to have one more dig at explaining smart beta in a layman way, and then I can actually take it from there, explain how this differs to RE, and how can people think of our global RE versus the Equity100 portfolio.
Okay, I guess I'll also sort of impinge a little bit, on your area, because in a sense, our area. Okay, in a sense, the Equity100 is not something that we created out of thin air, okay? It is actually a carve-out. So essentially, we've been actually using this as part of our global portfolio, okay? So, but when we use it in our global portfolio, we actually, we use this to increase the returns commensurate with taking risk, okay? So the focus of the global RE is risk management, okay? So what we want to do is we want to contain risk management, but if your risk management, let's say, for example, some of you have a 25% downside risk, okay? So in that case, what we would do is we will already have something like Equity100 in your portfolio existing, okay? So what we did was we actually carved it out. Now, why did we carve it out? Because some clients basically said, look, you guys are doing, risk management, and we, for example, want to do dollar cost averaging. We love dollar cost averaging, and your risk management is screwing up our dollar cost averaging. That's basically to be very polite about this, right? So end of the day, so we said, look, if you guys want to basically say, okay, look, forget about the risk side of it. We're prepared to take short-term risk because we're young, or what we give you is only a small percentage of our investment. So we carved it out and said, look, we will basically give you just pure equities. We don't manage the risk for you at all. It's all 100% equities, and you can use it whatever way you like. Okay, and of course, one of the ways that you can use it is what we call a core satellite strategy, where you put, let's say, 60 or 70% into the global product, and then you take 30% or 40%, and then you put it into the Equity100. You do TCA. You do whatever you want to do with it, right? Now, the point is that we've actually been using the smart beta strategy. What we used to jokingly, Dhruv and I call it slice and dice. Okay, but essentially, it has been something that's been under the hood that we haven't shown anybody. Okay, so essentially that's the thing. Okay, so now because we're offering it as a product, so we have to basically explain it a little bit better to say, look, we carve it out, but what exactly are we carving out? So if we just carve out the passive side, you guys can basically go and to a discount broker and just buy SPY. You can buy whatever ETFs, right? But we've actually added value by constructing this particular equity portfolio. Okay, so what we did is when you carve it out, we said, okay, we better explain this. What are we doing? Okay, so essentially you can do one of two things, right? You can basically say all passive. So we just take the MSCI World and we just replicate the MSCI World, right? But you can basically go and buy an ETF, URTH, or there's a couple of Vanguard ones that basically track the MSCI World. But that's not exactly what we do. What we do is we try and add value by adding this thing called smart beta. Now, so what smart beta is that we say, look, we recognize that if you pick stocks, okay, you want to pick alpha. The problem is that a lot of reasons why active managers underperform. Firstly, it's the cost, okay? But secondly is that when you bring alpha, when you bring a stock, you actually have beta as a baggage, okay? Now, for those of you who are not so familiar with alpha and beta, let me just put it in layman terms, right? Alpha is basically sort of idiosyncratic. So how good your management is, how well your company is run, and so forth, right? Beta is whatever's inherent. So if your company is a technology company, no matter what you do, if technology tanks, your stock's going to tank, no matter how good the management is, right? If you are running, let's say, an airline, okay, no matter how good you are, SIA is so good, right? But with this COVID-19, SIA also had to go out there and raise billions of dollars, right? So the systematic part of it is important, and that is what in modern portfolio theory you get compensated on, okay? The systematic risk that you're taking, okay? Now, what are the systematic risks? So from Farmer French, the systematic risk, the core systematic risks are things like when they first discovered it, 30 odd years ago, is, size. They find that size systematically gives you a return if you hold it long enough, okay? Small stocks. Value, if you hold it long enough, also gives you a systematic return, okay? So if you're prepared to hold it for 20, 30 years, okay, you're going to get a return by going small stock and going value. But, you guys sometimes come to us and say, hey, Syfe, what are you guys doing? Crazy or what? The last 3 months, you never even gave me any returns, right? So everybody has this recency bias, okay? And if you look at recency bias, not 3 months, but let's say you look at it on a yearly basis, then there is some cyclicality with respect to these factors. So in the last 3 to 5 years, and maybe even like up to 10 years, value has not been performing. So I have some good friends who run value funds, and they follow Warren Buffett and they say, look, this is like buying $1 for 50 cents and so forth, right? But the fact is that unless you're Warren Buffett, a small guy, you stand no chance, right? And the value investors over the last 3 to 5 years have been underperforming because this value factor, has been going down relative, to the growth factor. So what we tried to do was we said, look, we will model it, and then we actually tilt towards the factors that are working at this time, okay? And I think one of the questions that I saw, and I don't want to jump your gun, Ritesh, but somebody says, how often do you rebalance your portfolio, right? And so we envisage that we will not rebalance the portfolio more than twice a year, okay? Because factors move very, very slowly, okay? And so you have time to react. Okay, it's not like stocks. Okay, all of a sudden, the stock moves. It could be because the management mismanaged it. It went bankrupt. And there are a lot of stock darlings that basically go downhill, right? But I think I've sort of overstated my case. So Drew, why don't you take over and smooth it out a little bit? I always tend to get a little bit.
You get a little carried away, which is why we all love you. But I think in a layman terms, how people think of Equity100 and RE. I mean, I think that if you are a relatively new investor, or you don't think you're that savvy, we still think that RE somewhere can be like your core how do I say, your core investment for that, for yourself. However, given the fact that many times people have other so-called conservative investments anyway in place, whether you might have fixed deposit or Singapore saving bonds or CPF under SAOA, etc. There, and you are like, okay, I just want, let's say, 20% of my portfolio just to be in equities, right? So that I think fits in very well with the Equity100 mindset, because what we do with the Equity100 with the RE is we completely manage your portfolio, and of course, if markets are volatile like they were, we can potentially move to 80% of conservative assets, which is what we did when markets are volatile and still actually remain relatively high in this time. But some people on their end are like, what, I'm managing the so-called conservative piece. I want I want you to manage my so-called risky piece, or I'm happy to take this higher risk because what, I'm here for the long run. I expect over long run this will go up. In the short time, I understand this product is intuitively more risky, because with RE, we try to protect your downside, right? We ask you to choose a number, but here this is a pure equity portfolio. So I think the answer is going to vary case by case about how your personal finances are, and that's why our financial consultants and our financial advisors like Ritesh and his team can be very, very helpful in gauging and understanding your case. But how I think if let's say we are the only option that you are investing with across all your assets, then I would say a good portfolio will actually be a blend of both RE as well as the Equity100 piece. Yeah,
great.
We've got a lot of questions.
So yeah, we've got a lot of questions. So I think a more pertinent question, I think, digging in a little bit deeper into the strategy itself. So people, there have been a bunch of questions around this where, people want to know, why did we choose these three specific factors per se? And typically the factors that are, associated with, the generating superior returns are a little bit different. So how did we come up with these particular factors to focus on? And I think a follow-up to that is like, how do we rebalance the portfolio? How do we restructure it? How often do we look at these factors to sort of, change strategies and stuff like that? So how dynamic is this portfolio?
Ritesh, you want to go for the first part, and then I can talk a bit more about rebalancing? How do we decide the factors, and then I can talk a bit more about then the rebalancing piece?
Okay, you want me to address the first part?
Yeah, the factors. Yeah, please go for it.
Yeah. Okay. I think how we decided the factors was we basically modeled, the cyclicality of the factors. Okay. So one of the things that we look at, we just don't basically take, like Farmer French's work and we say we replicate all of this, right? So we actually read a lot of different academic literature. And one of the things that we actually apply is some work done by the late John Bogle, his seminal paper that he delivered 50 years ago to a class at MIT, and then about 20 years ago he talked again to Morningstar. And what he talked about, was this whole thing called reversion to mean. Okay, so what that means is that factors, as they go through their cycles, they always come back, to a certain level, right? So what we try and do is we try and model this cyclicality of these factors. So now, I guess all of you guys probably, are aware that when you look at value, the other side of value is growth. Okay, so if value is working, growth will not be working. Relatively speaking, when value is not working, growth is working, right? So these are two sides of the same coin. So what we do is when we model the cyclicality of these factors, then we look at which factors to load up on. Now, in addition to the Farmer French factors, We also look at things like, as I said, low volatility, right? And I think, I don't know whether some of you guys have seen this thing, where there was a hedge fund called AQR, which was this guy, Cliff Asner's. And basically, he wrote a paper called Betting Against Beta and Quality Minus Junk, right? So these are some factors that he came up with. And basically, when he tried to kind of like model Warren Buffett's portfolio, he found that actually Warren Buffett does invest in stocks that are betting against beta. He found this factor implicit in Warren Buffett's investments. So we actually look at a lot of different research, and we actually put these all together synthetically. And I guess one of the questions that we always get asked is, what's Syfe? Drew usually answers this one. Is why did you create Syfe? What's Syfe's purpose in life? What's your ethos, right? So our idea really is that we want to bring institutional style investing with sophistication and technology-enabled costs to the retail investors. Okay. Now, obviously, this is not altruistic. We want to make lots of money along the way, but in the meantime, what we're going to do is we will build the best model that we can build. Okay. And these factors are selected using some of these techniques. Okay. Now, I guess if you guys want a deep dive, I don't know whether we have some slides that sort of talk a little bit about this, and maybe we should get into that later on.
Yeah. I mean, maybe like depending if there's enough traction for that, we can potentially have a focused seminar just on that piece. So there's just like a lot of questions and a bunch of other slides which we might go through if time permits, right? The second question, I think, which people ask, like, how often do you rebalance and how dynamic is the rebalance? So I think, as Richard mentioned earlier, these factors actually move extremely slowly, right? In our experience and our back testing, etc., on average, the rebalancing is actually just once or twice a year, right? And bear in mind that this is still an equity to equity rebalance only, right? So it's not as dynamic as recently as was experienced with our global RE product. Of course, those were also extreme times, so they required extreme measures where we basically moved from equities to bonds. But given the fact that this is only catering to the equity piece, this will always remain in the realm of equity, and of course will be then very highly correlated with the market when it comes to performance. Ritesh, I saw one question which I would like to answer, which is why do you launch this portfolio in the most?
Yeah, exactly. I was gonna tell you about that exactly. So I think just to add on to that. So a couple of things, right? So number one question is, given that there is so much uncertainty in the market, there is the COVID situation, and still going forward, things are not clear how things will pan out and all. So does it make sense to invest into 100% equity portfolio at this point in time? And what is the rationale? Again, I think you touched upon it a little bit in terms of suggesting how people can actually use this portfolio to their advantage, and especially in conjunction with our RE portfolios as a sort of a strategy. Yeah.
So I mean, it's there's this old saying which says, like, there is never a good time and there's never a bad time. I mean, what might look like bad time might look very good time 3 months down the line, and vice versa. I do agree that volatility is high. I do agree that we are in relatively uncertain climate, right? I do agree that somewhere there is a reality on the ground which is slightly different from what's happening in the real world. Now, as I said, I personally would not put 100% of my net wealth myself in an Equity 100 portfolio, right? I mean, though I guess I was young when I started Syfe, but I still feel a bit young. So, but the point is that the way how we see it is that at the end of the day, if you want to have a higher tilt towards equity because you have a longer term perspective, or you want to add it because you have a lot of safe assets and you have a lot of fixed income and all, then this becomes a great product, right? So to answer your question, we might launch this product, a person might put $100,000 in this product, but that 100,000 might be only 10% of his or her net worth, right? So we think of it as a complement to an overall individual's to the overall individual's financial situation, and of course there has been a need and interest both yesterday and today after launch has shown that definitely there is people who have to, who take that view. And let me be very transparent. This is, of course, a relatively riskier, more volatile, product. It's not risk managed like our RE product, where we are trying to cap on the downside, right? I mean, if you want to look at the downside, then that is the product for you. But if you're looking at returns over a long run, an equity only offering will actually always, outperform, right? But over a long run. But you have to be mentally prepared to, have that, 20%, 30% correction if the markets do correct, right? So we want to be very transparent with that, and that's why my recommendation for most people will be like, don't put 100% of your net wealth out here. Again, every case is unique. Everyone's finances are unique. If we can help, Ritesh, Lester, Melvin, our entire advisory team, or myself, we'll be happy to look at your case specifically and advise you, what might be the right proportion for you to consider in the Equity 100. Does that answer the question, Ritesh, you think?
Yeah, absolutely. I think, definitely answers the question. And also, I think a lot of people who want to be a little bit more equity exposed, and during crisis situation, they want to take advantage and, sort of average out their costs and buy more, accumulate more. I think that this can be a great strategy from that standpoint as well. And just to follow up, I think there is another question around, do I do lump sum? Do I do DCA? What would be the kind of strategy that you would recommend in the current situation?
Yeah, it's a good question. Yeah, I mean, we had pulled these numbers, and I normally say that we should probably put it in our slides, but we did some research on this, and we realized that over a 24-month period, like over a 2-year period, a rolling 2-year period, lump sum actually has outperformed DCA 3 out of 4 times. So if you have the resources and if you're willing to, ride the volatility, etc., then I would suggest, go for lump sum, because over long term, the time you have in the market will always benefit you, right? If you are a bit more, skeptical about the market situation and, where things are, and, there's a potential under correction, so on and so forth, or let's say you don't have the resources, let's say you decide to put $1,000 every month because that's what you save from your salary. In that case, I think DCA becomes the, the choice. So I'm saying, if you're willing to take the volatility that comes with an Equity 100 product, and if you don't immediately need the cash, I would suggest to go for lump sum. I mean, because 3 out of 4 times it outperforms. But if you have some sort of uncertainty about the markets, or if you have a view that, things can't correct, or if you need cash, or only if your cash flow yourself is staggered because of, your salary and etc. coming in, then of course go for DCA.
Let me add a slightly different perspective, not different, but a kind of a sort of tilted perspective in that sense. In terms of why we introduced this product when it's such a volatile market, basically there are really 2 reasons. One is really because there are clients that felt that because we were managing risk, that we were too conservative. Okay, and they said, look, why aren't you basically giving me more equities, right? So by carving it out, we're actually giving the client an option. Now, if you find the market too volatile and you don't want that option, that's fine. I guess one of my old professors used to tell me, life does nothing but take options away from you, so keep all your options open for as long as you can. So we are actually giving you an option for you to exercise. Now, second thing is volatility cuts both ways. If you are, we have a lot of clients that basically love DCA, okay? As much as we tell them, look, do lump sum, 3 out of 4 times you win on lump sum and so forth, but for some reason they're wedded to this DCA investment strategy, okay? So I don't know whether it's kind of like brainwashing or some advisors out there tell them this kind of stuff, right? But if you want to do DCA, if you are wedded to DCA, volatility is your friend, because you can't do DCA on bonds, okay? When you do DCA on volatile stocks, right, essentially over the long term, think about it this way. If you have 100% equity, but you do DCA, essentially you end up with a 60-40 portfolio. That is the risk characterization of doing a DCA on 100% equities, right? The risk is brought down because you're averaging, okay? But you have to average on something that's volatile. If it's not volatile, it doesn't work. Okay, so essentially what we're doing is we're actually providing you this alternative that if you love DCA, here's a product for you. That's basically it. I don't want to sound like Johnny Carson and so forth, but I mean, essentially that's the whole idea. Right? I hope that gives a different perspective on why we introduced this product in such a volatile time.
Yeah, No, makes sense. And I think one more question to that is then a lot of people are actually DCAing into the global portfolio. So, how do they think about their DCA strategy going forward with the new launch?
Well, I mean, okay, from my perspective, right, firstly, I'm conservative, so I will never put 100% into the equity, partly because I'm an old guy as well, right? Okay, so if you're young, you're 20 years old, no problems. So I wouldn't put everything into the equity 100. But what I would do is, if I wanted to do the DCA, I certainly wouldn't do DCA on the RE product, because RE already has risk management built into it, right? So you're actually doing risk management and then you're averaging, right? So it's kind of like, you're doing two sort of risk management strategies at the same time. What I would do is I would basically put a core into RE, okay? And then if I wanted to do this DCA, I would do DCA on the Equity 100 piece as a satellite.
It might be worth mentioning out here that a lot of people, they think DCA basically, at least some of the newer investors, they think DCA means monthly contributions. That is very different from DCA. DCA stands for dollar cost averaging. So if you are monthly contributing because you're giving some salary and you're in the new job force and you want to continue adding your investment profile, by all means you should continue doing that both in RE or global or REITs, whatever you do, right? If you are DCing into from a perspective of averaging cost down, right, then I think the Equity 100 or the REIT product is probably much more relevant in that scheme of things. Yeah.
Right. One I think important question, I think going back to the slide where you guys showed the return profile for the portfolios, comparing it with the benchmarks, which is S&P, MSCI World.
Should I share my screen?
Yeah, if you could share that slide again. I think there are a few questions around how do they think about investing directly into an ETF versus using, this as a portfolio to invest, right. And where is, all the value add coming in. So, if you could share a little bit more on, the parts where the return alongside the standard deviation and Sharpe ratios, I think those are important things to, highlight, as well as in general, how can people think of, our portfolio versus, investing directly into, these individual ETFs per se.
Yeah, sure. Yeah. So I think, of course, we obviously, we try to get, the Sharpe ratio to be the most efficient as possible, right? And for some of you might not know what Sharpe is, it's basically, excess returns over the risk that you take, right? So if you actually see the Equity 100 has a much higher Sharpe than, let's say, the S&P, 500, right? And this actually, ends up now ensuring that you have lesser volatility, which is a standard deviation, which is great. But that actually increases, the annual return, right? So for example, in this example, right, roughly you have about a 1.5% annual advantage, which actually, you're getting by investing in this product, right? Not to mention, of course, all the other parts that come along when you are managing through a solution like us. For example, if you want to just go and, buy worth, a few $100s, you might not be able to get whole lots of S&P, or the brokerage that you'll pay at each time, or when the dividend comes out, the reinvesting of the dividends and all. So if you think of that entire service and managing all that piece in, right, I think from that angle, that is the convenience side of things, but also it justifies on a lower risk and slightly, a higher return. And again, I mean, as I always say, right, like with our global product, like with our REIT product, right, if you genuinely feel that you can go and, invest yourself, and then, when the rebalance happens, do it yourself and then do the dividends. And if you think that is, the value of your, time, then by all means, right? I mean, at the end of the day, even if you put like $10,000, 50 basis points on that is like $50, right? So you'll end up paying significantly higher in brokerage. I'm not even counting the time and the discomfort that you'll have to go through. But by all means, I think almost anything what anyone is doing, you can actually go and replicate. You can even buy an ETF. I would say just go and buy the underlyings, right? Why even pay that, 10 basis points to S&P, right? Just go and trade it yourself, right? So I think you have to really value your time. And I think given that we obviously will keep an eye and we will keep on, optimizing things as we get along, like we do with the REIT product, like we do with the global product. I think that value is something which people sometimes forget to value. And I think that frankly is very, very valuable. Much more, I think, in my view, at least, I would take that convenience factor much more than, the annual return and the lower risk, which by the way, anyway, the product provides. Yeah.
think a couple of more specific questions. I'm not sure if you want to answer them right away, or you want to cover some more slides in the meantime.
Yeah, I mean, the other slides we have are more on get started. So should we maybe I'll just do a quick overview on how we can get started, right? And then maybe we can just get on some other questions, right? Because it's almost coming close to an hour, but we will be here for some time. So let's get on, yeah. So we are both on App Store as well as Play Store, as well as on web. It's quite an easy onboarding. Depending on the portfolio you choose, we can actually recommend a portfolio for you. This was an example, with REITs. There's also like a forecast. A lot of people have asked, where can I expect, my portfolio to be? So we end up showing 3 levels of forecast, which is like conservative, optimistic, and the most likely scenario. So I think somebody had asked that question that what can I expect over time. And I think this is a great way to use Monte Carlo simulations to forecast 3 scenarios, so what is the so-called good case scenario and a so-called bad case scenario. Of course, after that, there's a beautiful little app where you can add funds, you can withdraw funds, you can change the portfolio name, you can build multiple portfolios, but at the same time see all your performance and all the metrics as the case might be, right? As we mentioned, like our fees is basically 0.4%, starting from 0.4%. It's all inclusive. There's no trading fees, no entry exit charges, no minimum balance, unlimited rebalancing, if you want to take money in, take out, for example. And again, there's unlimited, free withdrawal. So for someone, who basically had mentioned about why don't I just trade S&P? I think, again, if you have to keep on trading it on a regular basis, whether it's a DCA thing, whether it's reinvesting the dividends, or it's just rebalancing the components to get the most optimal smart beta yield, at an individual level, it's never going to make sense. But actually for us, economies of scale work because we have all these customers, and we can actually make it a very low cost setup, which we can pass back to our customers. So the next question is like, where is our fees, right? So we start, depending on how much you invest, the pricing actually keeps on decreasing, right? So if you have, even like if you have $1 to invest, by all means you can start, and it's going to be 65 basis points. But I mean, be prepared, even at the 13% return, it will be 13 cents. So maybe not worth your time. But also as you increase and you move to black and gold and platinum tiers. So black tier starts at $20,000, and the fees then falls across everything, right? It's not 0.65 till 20. If you're more than 20, everything falls to just 50 basis points. And if you go across 100, it comes to 40 basis points. Additionally, we even have access to financial advisors, which is free for blue customers for the first month. The black team gets and access to a team of advisors, but for the guys in the gold program, they actually end up getting a dedicated advisor. This is across all products. So this 100K does not need to be all in Equity100. This can be across REITs, across our global, and across Equity100. Now, the good thing is that for whatever reason, let's say you invest $20,000, and if the market's correct, we will still charge you on basis of the value you've invested. On the other hand, if you invest 19,000 and it goes up to 20,000 or above 20,000, we will charge you based on 20,000. So we will take the higher of your deposited amount, your net deposited amount, or the market value, right? So it's a very pro-customer approach, which is what we've built at Syfe, and something I thought which is worth highlighting. So again, right, I mean, we typically talk about, some of the things, depending on why can't I do it, right? And typically somebody asked like, why DIY, right? And I think a lot of things are there, right? So for example, there's no need of a brokerage account, the time required is basically minutes, where relevant, not probably for the Equity100, but at least for the other options is the risk management, but also automatic reinvestment of dividends, automatic, reoptimizations, and there is no brokerage fees, right? And this is typically quite significant. And people sometimes don't value, they see, oh, my brokerage fee is only 10 basis points. But most of these brokerage have a minimum dollar value, right? To hit that minimum dollar value, you might have to trade $10,000, $20,000 each time you trade, right? So actually it's quite significant, right? And of course, though our management fees is quite low, a managed strategy like this in the market will charge you all these things, and on top of that, charge you anything between 0.5 and 1.5%, right? A classic example is if you invest in a fund, for example, where they will say, oh, we don't charge you brokerage, but their fees is so much higher, which actually ends up, killing. So so obviously the ETFs are so much of an advanced structure and so much more efficient that despite all this, it's much cheaper than, doing, and let's say getting for any of the fund structure because they're so much more expensive, right? And of course, there's no entry and no exit charges. Somebody asked us about, our licensing. So we are CMS licensed by the MAS. Funds are always held in a trust account. In fact, when you transfer funds to a trust account, which is actually completely separate to Syfe's own account. It's managed actually, it's at DBS, and from there it goes to Saxo, whose further sub-custodians are Citi for US securities and HSBC for Singapore securities. In Equity100 case, given it's US, it's actually all all securities essentially held by Citi. To address the elephant in the room, sometimes people ask what happens if something goes wrong with us. The CMS license actually is a very tough license to get. We almost spent a couple of years working on getting it, and it actually puts very severe thresholds, right? Like full-time internal compliance, external compliance, internal auditors, external auditors. A Big Four is our external audit. Quarterly reporting to the MAS. There's a professional indemnity insurance. There's $1 million of base capital that has been placed with the MAS. So essentially, they have a lot of checks in place to ensure that we are operating at full efficiency and we are ensuring the assets of our users are safe. In the God forbid episode that something does happen to Syfe actually is not the ultimate beneficial owner of these assets. So in fact, our bank account, our corporate account is completely different even from any of the banks or entities you see on your screen right now. So even if something goes wrong or something happens to us, the assets actually get returned to the end owners, or alternatively, if another fund manager wants to acquire their assets, they can end up acquiring those assets as well. This is something which you should be mindful of. So even if something happens to Syfe, your assets still remain safe all through the journey, right? And I think that's a very important thing for you to know. We are a team of over almost about 35 people now, but some of the key members of our investment team, myself, most of my experience actually has been in UBS, where I was a portfolio trader first, and then started the ETF distribution desk. Richard comes with a glorious past. He was teaching at NUS, and his subject of teaching actually was something similar to his title, actually, portfolio construction and risk management, but also has held very senior positions before at Lion Global, as well as CEO for UOB Venture Management. Fun trivia about Richard: he was the founding member of Cymex in the late 80s. So he's seen a few ups and downs, right? Ritesh was also on this call, was recently working at Goldman Sachs, but before that was the VP for market risk at Morgan Stanley. And Akiko, who's not on this call, is one of the sharpest people I've worked with. She was a fund manager formerly at Tokyo Marine, but also has been a quantitative advisor at Mizuho. So she's a PhD FRM, one of the smarter peoples in our office.
Yeah, so we call Akiko our AI.
Yeah, Akiko's intelligence. Right? Yeah. So as you can see, right, we come from diversity of not just academia, but also from heavy world-class, world-leading banks, right? And I think Richard alluded to this point very, very well. I think we somewhere want to give that institutional level of service using technology at a low cost to the masses, right? I mean, as a retail customer, I don't know how often do you get a chance to speak to somebody who's been a former private banker at Goldman Sachs, but if you're lucky enough to get Ritesh's time, it's a busy calendar. Even I can't get time sometimes, So that's the level of service, and of course we want to be given how we are structured also, right? We basically make fees on your assets remaining with us for a long period of time. There's no entry, there's no exit. So we're very conscious of what we sell, because if you come on board and let's say if you leave in 6 months, actually we end up losing, So the goal is not really to, have a setup where we are selling a wrong thing to you and then, getting, because you will leave and, we'll actually not make any money out of it, right? The only way this business becomes a business is if our users stay invested for a long time. And that's when we build products, before we're getting on this seminar and you are seeing this product, we've actually spent a lot of time with a lot of users to cater to, what they need. And, that went same thing when we launched our global product. The same thing went for the REIT and same thing for our Equity100, and the same will continue with products in the future. Before I get on to a quick promo code and some questions, there's a super interesting, session for those who want to understand a bit more about sector ETFs. We have some of the top management and managing partners at State Street. who run the popular Spider or the SPY US or GLD, both in Singapore and US. And if you want to understand a bit more, they will be joining us for an expert seminar series. And please, do sign up. You can sign up from the same channel that you've signed up for this course. And I think it's going to be a very good and very interesting session. Lastly, if you complete this feedback form, and if you're a new customer to Syfe, if you're an existing customer, I hope you find enough value in the platform not to require a promo code. But if you're a new customer, there is a promo code for completion of this feedback form, because we are also learning, we're also trying to get better. And as you can see, how much you invest, that amount varies. You can find the promo code by quickly getting this QR code. With that, I am going to keep this for some time. And Richard, should we move to some more questions? Because I see a lot of questions still pending. Yeah. Can you combine a few of them and try to address as many as we can today?
So I think a few questions around, and I guess you guys already answered it a little bit, but if you can go back to the slide where the dividend withholding tax is mentioned. So why do we not choose some of the UCITS ETFs per se? If you could, summarize a little this particular slide one more time. And I think alongside this, even the estate taxes per se, right? So that's also a relevant question to this regard.
Sure. Let's address both those questions, right? Firstly, the thing is that we would love to consider UCITS if it made sense. The fact is that because they are so illiquid and so tough to trade in secondary markets, right? If you see the bottom line, right? The spreads and liquidity actually themselves make UCITS actually a bit unattractive typically for real investors, and also for the model, that we have, we're actually trading, on your behalf, right? So actually it's not that effective as some people make out of it, right? The second big misconception people have is that this will make a difference of between 15% and 30% of my entire capital gains. It's not true. It's only on the dividends, right? And the global equity portfolio, the dividends are relatively quite low to begin, right? I mean, as you can see in QQQ, the dividend, right, which is a significant part of the portfolio, is only about 67 basis points right now, right? So the dividend itself is not that high. So firstly, if I just look at the difference, that 15% difference, on 67 itself is actually, not that high. Now, if I look at QQQ, and we've actually compared it with its UCITS funds, right? The withholding tax on QQQ, though, is 30%. Post-tax dividend is actually 46 basis points. For EQQ, the dividend yield actually slightly lower the way how they are structured, and the dividend itself is actually somewhere around 56 or 57 basis points, right? From there, if you remove another 15 basis points away, effectively what you get is, 49 basis points. So you are right, you make an extra 3 basis points. But in this case, the fees itself is actually 10 basis points higher, right? The management fees of this thing, which will, which comes back to you. So effectively by using QQQ, actually you're saving 7 basis points, right? Of course, if the dividend, goes up and it starts making sense, we will, reconsider it. But right now, just even from a pure numerical sense, just if I look at in isolation, it does not make sense, right? Now, so for some of the other ETFs, like the sector ETFs, they're actually not very liquid, right? And this is something, feel free to ask the guys at State Street, because they're the fund managers of that ETF, right? We've been discussing about it. They just realized, given the magnitude that typically investment and investment sizes are, trading it on the market might not be the most cost-effective option. So you might think you might save a little bit on, withholding tax, but you end up paying much more on crossing the spreads. And in certain cases, you just pay much more on management fee. There's a lot of misconception around it. But I think what you can rest assured is where it makes sense, we will use it. Now, for example, for the S&P, it makes sense. And we have actually, we use the UCIT fund out here, which is actually not only slightly cheaper in fees, but you also end up saving other, a little bit on your how do I put it, on the withholding taxes, right? So where it makes sense, we will use, and we will continue doing that as time goes by. What was the other question, Ritesh? On estate taxes, if I'm not mistaken, right? Yeah. So it's estate taxes is an interesting question because, and I'm really hoping we're actually getting a legal expert to join us very soon on this matter. Our current understanding is that estate taxes are actually not applicable. And that is because we are structured as an omnibus, right? But before I put this out in writing, I'm waiting for, or rather we are waiting for a confirmation from our broker Saxo to actually, confirm on this piece. bear in mind that estate taxes start kicking in if you cross a value of $65,000. So my suggestion to you would be start at $60,000, leave it with us. And by the time, we come back, you can then probably increase and upsize from that point, right? But, be conscious of this fact that, people create a big this hue and cry, but I think there's misunderstanding. But given how we are structured, our understanding is actually this is not really applicable, but we will come back with a more formal reply once we've done a legal deep dive. But up to $60,000, you're fine. So, let's start out there and then we can, address it as we get along.
Great. I think this one question gets asked to us fairly commonly. So, question about, what differentiates Syfe from all the other platforms that are available in the market?
I don't even know where to start. I mean, there is so much. Right? So, I don't know how many platforms had 3 very different products in their first year and which are catering to user needs. I don't know if any platform has a REITs offering. I don't know if any platform has an Equity100 kind of offering, which is built on ETFs. I believe someone's doing it with funds, which are ridiculously expensive and quite misleading in their nature. I think also, if I have to add to 2 other points, our RE actually is very, very unique. It's basically grade A institutional service. Some of the users might be a little awry because, you didn't catch up the market rally in the last 2-3 months, but we ended up losing so little. So net, most of those portfolios are still doing actually, I think all of them are doing better than benchmark still, right? And actually up in their own regards. So I think the aspect of genuine focus on risk management, right, or improving the risk return, not just in Equity100, because there we're not dynamically changing things, but at least in the RE, I think is very, very unique. So if you think RE is very unique in its approach of risk management, the REITs is very unique in its approach because it's the only one, partnership with SGX, etc., as the case might be. And then Equity100 is one of its kind offering as well. I think one more thing that I would like to mention is that we actually have a genuinely dedicated and high quality team of advisors, with Ritesh and his team, where we genuinely want to help you to achieve, your financial goals. And, it's quite interesting. Like a student sent an email to me last week saying, I have $25,000. I have to pay some 7% interest or 6% interest on it. I'm thinking of putting this money into your product, right? Because I think I can make more. And I told him, I think over a long run you will probably make more. But if you're going to get 6% guaranteed, because it's almost getting 6% guaranteed if you're not paying that 6% away as your loan fees, go ahead and do it, right? So did I lose a customer? Yes. Did we, lose $25,000? Yes, but that was the right thing to do. And that's a trend you will see with our advisors also, right? Because we have, as I said, we have no entry exit commissions, right? So we only benefit as a company if you are not just here for months, but for years and decades, right? So I think using that advisory team to your advantage, and I know a lot of clients have benefited from it, but I think something that even you can value as time goes by.
Great. Couple more questions around the robo-advisory business. I mean, people typically associate, the digital wealth managers to be robo-advisors. So, and one of the questions is, this seems to be a human-managed fund. So, how do I look at you as a, sort of investment house, and what are the value adds that I'm getting by investing into the platform?
So what is the question? The question is that, because does this?
So I mean, usually people associate, the digital platforms to be robo-advisors where everything is automated, right?
Yeah.
Whereas the Equity100 portfolio looks a little bit like an actively managed fund. So,
no,
what is your take on it?
No, absolutely not. Yeah. I mean, we are not like Richard, myself, Akiko, Ritesh, Ashraf, the investment team. We are not stock pickers. We are not like, woke up on the wrong side of the bed and, let's buy, Chinese stocks because that makes sense. For us, actually, the goal, if you think for the global product, has always been to manage risk. So the decisions of how to trade, how to transact is completely rule-based. Just the way the composition of Equity100 is completely rule-based, right? So yes, humans decide the rule, but we don't end up, cherry picking things out. So when you think of a robo, our algorithms are actually a bit like robots, right? But we have humans to help you understand them, which is where the advisory team starts coming in. So don't confuse our human touch by human intervention. because that is not the case. The algorithms still decide, what is the right thing. And, we've spent a lot of time, we've done extensive research, extensive back testing on this. But the human leg actually, helps you to understand this better, right? So sometimes people come and say, oh, can I remove one ETF and put the other one? I'm like, no, for that you go to a broker, right? Because we are, an algorithm, a rule-based setup. And in that aspect, we are like a true robo-advisor, right? So.
Great. I think a couple more questions around the ETFs and the management fee associated with them. So if you could share a little bit about the underlying ETF management fee that are applicable.
Yeah, so on average, I don't have all the numbers here, but on average, the fees is about 15 basis points across, all the different, ETFs that we charge, which actually in layman terms is $15 for every $10,000 invested. So actually it's extremely, extremely low. And I think for the quality of, management and the diversity of, products that you're getting, I think it's actually a very, very low price. So this also, by the way, goes into our consideration. And one of the reasons why we did not choose EQQQ over, let's say, QQQ.
Great. One more technical question around, the sectors that we have selected and the representation of the different sectors. So the question is around, considering the strong healthcare industry in the present and also in the previous years, wondering how come the Equity100 only has, I think, 12% allocation to healthcare industry?
Okay, I guess that's my question, right? Basically, we don't basically pick stocks, nor do we pick sectors. What we do is we pick factors. Okay, so the sector funds are basically, loading on to the low volatility factor. Okay? And so what we did was we actually created a basket of sector funds that basically gave us, the lowest volatility for the best risk-adjusted return. Okay? And, I guess on the one hand, there's criticism about us using too much people, but this one is purely algorithmic. So we actually wrote the program, and then essentially this is what the computer told us, is the best combination, right? Not that the computer decides, but we put a lot of thought behind that in terms of optimization, how to do it, and so forth, right? But it's all rigorously tested, academically based, and in a sense that those 4 ETFs are put together in such a way that we actually load up on the low volatility factor.
Great. Dhruv, anything to add on that, or?
No, I think that's actually quite comprehensive. Yeah.
All right. So a follow-up question to you, Dhruv. How much of your own money is invested into these portfolios?
I would say, as I said, that let me say, about the entire holding that I have at Syfe, I would say close to about maybe 20% is in Equity100. I was one of the first early clients, but I will add more. So currently I'm actually, my bigger chunk is still in the core, which I think is Ari, but about 20% is in Equity100. How much of my net wealth is in Syfe? I would say probably 99.97%, because Syfe is everything. It's an all-in bet, right? So we better build high quality products which our users like. Yeah. So.
Awesome. One more question, I think, around performance and how the portfolio would behave under different market situation. So I think the question is around how is the portfolio, doing during the COVID situation, and like year to date, what are the kind of returns that we've seen for this portfolio vis-a-vis, say an S&P 500?
Yeah. Do we have those numbers?
Yeah, I think the slides show the last 1 year, right?
Yeah.
Yeah, so I think I remember on the back of my head, the overall year-to-date numbers are -3%. So versus S&P, which is minus, I think, 5%. So we've done a little bit better. And even in the slides, I think there is those bar charts which show the yearly.
I'm just going to share my screen once more. Yeah. I saw numbers of last 1 year. We can get those numbers also year to date. But you're right. I think the outperformance is quite clear in that aspect, right? So, so last 1 year, for example, you can see the difference is almost 1.2% or so, right? So,
Yeah, the 2020, the bar chart showed.
Yes.
Yeah, exactly, right. So I think it's something. Well, it's a bit like get exact numbers, but I think it's you can see the difference out here. But this, I think this number is still only 17th April. So I mean, the outperformance actually
April, yeah.
is also quite clear. But to be honest, actually, we should have done quite well because of the heavy QQQ weight. But I think we should probably update these numbers out for the next session as well. So.
I think some of these numbers, actually, the latest numbers are on our website. So as Dhruv was mentioning, some of these data might not be latest. So if you actually go onto our website, you will be, all of these are actually shared even before you create your account. So essentially, you can look at our portfolio, you can look at the performance numbers, and year to date, I think the numbers are updated till, I think 23rd of June or 30th of June. And what I saw was it was negative 3% versus negative 5% for S&P. I think more or less most of the questions are covered. There are a couple of questions around if we have plans to expand beyond Singapore to Malaysia. There are, I think, a few
You just blurred out, but I guess your question was, are we going to expand outside Singapore? Yeah, definitely. I think for any company which is in our domain we've already I think built an incredible technology and a platform, and I think it would be a mistake not to extend it outside Singapore. Having said that, we actually already support clients globally. We have customers from about 23 countries, residents of 23 countries already. So if you are currently, let's say in Malaysia, or you're dialing in from Indonesia or one of those markets, you can actually still sign up, right, on our platform. There's a slightly longer due diligence process which we have to do because of law, but it's still relatively quick, and we should be able to onboard. And we have customers from all these countries as we get along.
Great. I think overall, most of the questions have been answered. So, Dhruv, any other closing thoughts that you had in mind? Richard as well.
Yeah.
Well, I mean, I think we've said pretty much all of what needs to be said, right?
No, guys, so please, would love to get your feedback, any thoughts, any questions, we have not been able to answer. Please, by all means, drop us an email at support@Syfe, or our own emails are actually on the team page at syfe.com as well. So please, feel free to reach out to us. And, we are always improving, always listening to our customers. So love your feedback, and would love to, learn from you and build products that would make sense and help you achieve your financial goals. Thank you so much for your time. I really appreciate you joining us this evening.